On both sides of the border today, David Rosenberg's been tracking it all. He's the chief economist and strategist at Gluskin Sheff Associates, and he joins us now from the TSX. David, good morning. Thanks for joining us. And as always, let's start with the Canadian picture. What was your takeaway from the September jobs report?
Well, obviously the headline surprised to the upside, but most of the gains, in fact, all of them were all in part-time employment. What really caught my eye was the wage number, because what's more important than what sort of income growth the labor market is providing for Canadians. And the wage growth numbers are actually cooling off quite a bit. The year-over-year trend in wages down to 2.4% was 2.9% in August. At the start of the year, it was barely more than it was about 3%. We're down to the low twos. So we're seeing wage growth decelerate, which is telling me, if I'm at the Bank of Canada, that there's probably more slack in the labor market than that headline unemployment rate would otherwise suggest.
Well, at this stage of the game, and we're getting awfully close to the next decision by the Bank of Canada on interest rates, most market participants seem to think that the bank will hike rates. And of course, we'd already seen 4 hikes dating back to last July. But I remember our last conversation, and you were just raising the question, does the Bank of Canada need to raise rates? In the face of data like this, what would you say to that?
Well, I would. My view on that hasn't changed. I don't see the urgent need for the Bank of Canada to raise interest rates unless perhaps they want to collect more bullets in the arsenal to cut rates when we embark on the eventual next economic downturn. For a long time, people were saying that about the Fed when they first started raising interest rates a couple of years ago. But the situation with the U.S. is completely different. I mean, the question I would pose back is, where's the fiscal stimulus in Canada compared to the gargantuan fiscal stimulus that we have in the United States? It's very clear when you're taking a look at the acceleration in wages in the U.S., where their jobless rates are, both on the surface and beneath the surface, that the Fed has a lot more work to do. I don't see the case for the Bank of Canada. I mean, of course, they're going to raise rates on October 24th. That's in the cards. I just don't know how much more they'll have to do. What I do know with certainty is that whatever the Fed has to do, the Bank of Canada is going to lag way behind. And those negative interest rate differentials at the front end of the yield curve that has been principally behind the pervasive weakness in the Canadian dollar is not going to go away anytime soon. Those negative interest rate spreads are going to widen out. And no matter what commodity prices do, the loonie is going to remain a flightless bird as far as the eye can see.
Okay, lots to chew on there. And just going back to what you described in the past as a complete mirage when it comes to the U.S. economic growth story, you're basically saying because of some of those stimulative efforts south of the border, tax reform probably being chief among them, that has created a different storyline for the U.S. growth and maybe one that the Bank of Canada has to keep in mind.
Well, and if I'm not mistaken, almost every other central bank in the world is keeping that in mind. I mean, I was saying this earlier. Is the Bank of Japan raising rates? No. Is the ECB raising rates? No. Most other central banks, I mean, outside of the emerging markets where they have to defend their beleaguered currencies or where there are inflationary pressures that are significant, well, they're raising interest rates. You can come back and say, well, Canada is so closely tied to the U.S. How can our monetary policy diverge from the U.S. for very long? And I agree with that. But the U.S. economy is performing beyond excess capacity. It is very clear under any benchmark that the U.S. is way beyond its output gap. We are not yet quite at our output gap. So in other words, there's a big difference between where we're operating in terms of productive capacity and full employment and the United States. So the bank will go at the end of October. The need for them to go much beyond that, I think, is actually quite suspect. Yes, go ahead.
Let's talk a little bit more about where we're going. We talk to strategists all the time about whether you should invest in stocks, maybe buy some more defensive stuff. Recession risk, and I think I'm talking a little bit more about the U.S., but it's worth having a conversation about Canada as well. It seems to be coming up more and more as a subject. I guess what I want to know from you, because you've made the argument in the past that you don't think that the recession risk is properly priced into the different assets that make up the market. Has your view on that changed at all?
Not a bit. And what's interesting is that, you bring up recession risk as being a topic, and yet the widespread answer from the consensus is that a recession isn't coming for at least another 2 years. A view promulgated by Jerome Powell just 2 days ago, when he talked about how he doesn't see a recession in the next 2 years. It reminded me of Ben Bernanke. Ben Bernanke in January 2008, as the recession was starting, said that there was no recession in the Fed's forecast. Alan Greenspan said the exact same thing back in 1999 into 2000, and we had a recession starting early 2001. My major point is that the U.S. is running out of workers. I think one of the major pieces of data in the U.S. labor market figure today was the pool of available workers plunged again. It's down to an 11-year low. The unemployment rates across the spectrum are heading lower. Wage growth is picking up, and the Fed is raising rates. This is classic late cycle activity. And the one thing we know about the business cycles over time is that they have a beginning and they have an end. And every single end to the business cycle happened under these circumstances: inflationary pressures, wages accelerating, the Fed moving from behind the curve to ahead of the curve, raising interest rates, which Powell just told us they're going to do more of. And interest rates, after all, is what brings cycles to an end. So I am concerned, not for the next 3 months, but in the next year, I think we'll see more evidence that recessionary pressures are actually building, and I don't think that's fully priced in to any asset class at the moment.
Against that backdrop, do you think it's a good thing that we're sitting here on this Friday with a new trade deal, a new trilateral arrangement between Canada and Mexico and the United States, which a week ago we couldn't say whether that was going to become a reality?
Well, I guess the best we could say is that we dodged a bullet. I don't think that this new trade deal is better than NAFTA 1, but it's certainly better for us that if Donald Trump had simply walked away, which is what he threatened to do. So this isn't perfect. It's certainly not great for us based on what we already had, but it's a lot better than what the president was threatening to do last year. Does it really spin the dial that much on economic growth? No, it doesn't. I think at that margin, just getting the uncertainty out of the way could unleash some business investment growth in Canada, which has been lagging. I mean, the one positive I'll say about Canada is that industry operating rates are over 85%. There is a lot of investment potential waiting in the wings that hopefully will be put to work in the economy. A lot of survey data points in that direction as well. To me, business investment, unlike consumer spending or housing, typically is productive, so it's not inflationary spending growth. But that, I think, is going to be the positive story for Canada beyond, say, exports and what a cheap Canadian dollar brings in that regard. But I think that if there's an upside surprise for Canada at a time when housing is going to be flat at best, consumer spending I'm not very bullish on. CapEx growth is an area that we're investing around at Gluskin Sheff, and part of the economy I think that we can expect will improve over the course of the next several quarters. Okay, and before we go, I guess that all factors into your assessment of the Canadian dollar as a flightless bird. I don't know if that was your Thanksgiving reference or... Yeah, well, at least they didn't call it a turkey. We're at 77 cents right now. You just think we're going to hang tight around this level? We probably will just hang around, but let's say that in this game, in economic forecasting is all about, drawing the probability curve. What is the likely outcome? If you're going to ask me around 77 cents, where's the next 5-cent move, up or down? I'd say probably down. So I would see 72 before 82. That's how I would draw that curve. The fat part of that curve is towards weakness, not strength. Okay. Always good to get your take, David. Thanks very much. Have a great holiday. You too. Thanks again. David Rosenberg, chief economist and strategist at Gluskin Sheff Associates, joining us from the TSX. We've got a lot coming up.